Thinking about where to put your hard-earned money? Two of the most popular options are property and stocks. But which one is right for you? Let's break down the pros and cons of both so you can get a clearer picture. This is just for your information, not financial advice, of course. First up, property investment. The biggest pro? It's a tangible asset. You can see it, touch it, and even live in it. This gives a lot of people a sense of security. Plus, you can generate a regular rental income, which is great for cash flow. And let's not forget leverage. You can use a mortgage to buy a much more expensive asset than you could afford with cash alone. If the property value goes up, your return on your initial investment can be huge. There are also potential tax benefits, like deducting expenses related to the property. But it's not all sunshine and roses. Property is famously illiquid. That means you can't sell it quickly if you need cash in a hurry. The process can take months, and the entry costs are high. You need a significant down payment, plus you'll have stamp duty, legal fees and other costs. Don't forget ongoing expenses like maintenance, insurance, and property management fees. If your property is empty, you still have to pay the mortgage. And finally, the property market is local. If the economy in your area takes a downturn, so might your investment. Now, let's switch gears and talk about the stock market. One of the best things about stocks is liquidity. You can buy or sell shares on any business day, usually within seconds. This gives you amazing flexibility. The entry barrier is also much lower. You can start investing with just a few dollars, which makes it accessible to almost everyone. Diversification is another huge plus. It's easy to spread your money across hundreds or even thousands of different companies, industries, and countries, which helps to manage risk. Plus, you don't have to deal with tenants or leaky roofs. Historically, the stock market has provided strong long-term returns, often outpacing inflation significantly. So, what are the downsides? The main one is volatility. The stock market can be a roller coaster with prices going up and down dramatically, sometimes for no clear reason. This can be stressful, especially for new investors. Unlike a house, you don't have a physical asset to hold on to, which can feel less secure. And while you can get dividends, they're not always as consistent or predictable as rental income might be. It also requires some research and understanding. If you just jump in without knowing what you're doing, you could lose money. Emotional decisions, like panic selling during a downturn, are a big risk for stock investors. So, who is each one for? Property investment might be a good fit if you have a decent amount of capital to start with, you're in it for the long haul, and you like the idea of a physical asset that generates regular income. You also need to be prepared to be a landlord or pay someone else to be one. On the other hand, stock market investing could be for you if you want more flexibility, a lower entry cost, and the ability to easily diversify. It is great if you prefer a hands-off approach and can stomach the short-term ups and downs for potential long-term growth. Ultimately, the best choice depends on your financial situation, your risk tolerance, and your long-term goals. Many successful investors actually do both, balancing property and stocks in their portfolio. The key is to do your own research, understand the risks, and make a decision that feels right for you. I hope this breakdown helped you understand the differences a little better. What are your thoughts? Let me know in the comments below. If you found this useful, give it a thumbs up and subscribe for more content like this. Thanks for watching.